Hi, everyone. Thank you for joining us this afternoon for our event on GameStop and Robinhood. I'm Libby Seguin, the manager of the Center on Law and Finance here at the law school. A couple of housekeeping items. We are going to have our panelists talk one at a time. And after all have spoken, we will take questions. Please send your questions to me in the chat, or when the time comes, please raise your hand. The button is at the bottom of your screen and I will call on you. And now I have the honor to introduce our panelists. First, we have Professor Todd Henderson. Professor Henderson is the Michael J. Marks Professor of Law, and his research includes corporations, securities regulation, and law and economics. Next, we have Professor Tony Casey. Professor Casey is the Donald M. Ephraim Professor of Law and Economics and Faculty Director for the Center on Law and Finance. His research topics include business law, finance, and corporate bankruptcy. Last but not least, we have Professor Joshua Macey. Professor Macey is an assistant professor of law, and his research topics include energy law, corporate law, and the regulation of financial institutions. We will now hear from Professor Henderson.
Hello, everybody. Great to have you, and it's super to share the podium with the virtual podium with longtime colleague Tony and our new and rising star Josh. Okay, I'll keep my remarks kind of brief. A couple of topics and just sort of set some background that hopefully Josh and Tony will build on. A couple of preliminaries. The first one is short sellers are heroes and they should be treated as such. Hedge funds are not bad guys, but they are, like everybody else, greedy and sometimes it seems vindictive. Markets work, but being human institutions full of humans, they sometimes go astray. And this is probably an example of that. We should all care about market prices because Wall Street is the nerve center of our capitalist economy, but it doesn't seem like it has, this incident has caused any major disruptions. The punchline from this episode is not too bad. No capital was misallocated and the net social gains and losses are probably zero, but maybe worse things are ahead, so we'll see. So the first thing is, what is short selling and why did it get into trouble here? Well, short selling is a needed sanity check on market exuberance. If you could only bet that something is going to go up, then you can bet that the thing is going to go up. Of course, everybody hates shorts because they profit from failure. This is just silly. There's a lot of hatred that is generated at people who are financial middlemen, and shorts tend to have the cultural worst of that. But we need to purge that from our sensibilities because, you know, as a recent op-ed in the Wall Street Journal pointed out, they're like investigative journalists, and the market is like politicians. One of the reasons that shorts can run into problems is because the math is against them. If you bet a stock is going to rise, you buy at $10, hoping it goes to 20 or maybe 1,000. If it goes to zero, you lose $10. If it goes to 1,000, you make $990. Your downside is capped when you go long. Your upside is unlimited. Shorting is the exact opposite. You bet a stock's going to fall. You sell it at $10, hoping it goes to zero. If it does, you can make $10. Your upside is capped. Your downside, infinite. If it rises to 1,000, you're out $990. So shorting is way riskier than going long. You might ask, how do you sell something that you don't own? Well, you can't. Regulation SHO forbids that. So you have to borrow it or promise that you will borrow it. You borrow a share from someone and you promise to give it back to them in the future. You borrow it and sell it. If you borrowed at $10 and the stock drops to $3, you buy it at $3, return it, and make $7. Well, who lends stock? Well, everybody. Lots of index funds are sitting on tons of stocks they're not doing anything with, and they can lend it out for a tidy little fee. And that fee allows lots of funds now to basically charge nothing. You can get a Fidelity market fund that tracks the entire US economy for free. And the way Fidelity makes money is by lending out those shares. In normal times, this works okay. Shorting isn't super hard, but as GME showed, things can get a little crazy. But the principles behind this are pretty straightforward. This was a simple short squeeze. What it appears to be, and I know people are hung up on Reddit and the little guys sort of teaming up on the big guys. I think this was just big guys teaming up on big guys. Some hedge funds teamed up against other hedge funds. And the way they stuck it to them was they bought up a bunch of shares that would have been freely lent out to short sellers, lent them out for a while maybe, and then recalled them, brought them back from the short sellers, made the short sellers return them. When they did that, there were fewer shares for those short sellers to borrow in the market. And that basically squeezed the number of possible shares available to be lent out. And that made it harder for short sellers to be short. Those short sellers who had been borrowing shares needed to find other shares that they could borrow. They couldn't do that because the supply got constricted. The rates people were charging for those went up, and that created a feedback loop, especially as the price starts to rise. As you start losing more and more money, the people you're borrowing from demand at a higher and higher rate to borrow those shares, and that can create a feedback loop. People have to mark their losses to market. They may face margin calls from their brokers or from the people who are lending them out, and that can create a vicious cycle that can take a stock that is a dog with fleas like GameStop, worth about $2, and send it up to $480 some. When I checked the market when it closed today, I think it was down to about 90, headed towards zero. And all of that increase, very likely in inflation driven by vindictive hedge funds trying to squeeze out a hedge fund that was short GameStop. Now, what did Robinhood do in all this? Robinhood's just a broker. They arrange the purchase or sale of stock for their customers, but they're just matching with somebody else who is either buying or selling. And in the US, those trades happen 2 days later. And there's a lot of back office plumbing that has to happen to make sure the share gets from me, who's the buyer, or a seller, over to, say, Tony, who's the buyer. That back office involving clearinghouses, very settlement companies, custodians that hold those shares because we're not mailing them back and forth to each other. That process is pretty cumbersome and full of risk. There's the possibility that if I buy or sell a stock and 2 days later the price has moved dramatically one way or the other, that I will just be able to walk away. I might be bankrupt because I made a really bad deal. In that case, I may not be there to either pay for the stock or deliver the stock that I was promised. The clearinghouses solve this problem by basically buying from the one party and selling to the other. They take on all the risk. They eliminate counterparty risk, the risk that I won't pay Tony or Tony won't pay me or whatever it is. To do this, those clearinghouses demand collateral. If Robinhood is sending a ton of demand to them, they say to Robinhood, look, some of your customers might not pay. You need to give us collateral in the event they don't, because we're taking on that risk. When the risk goes up, there's huge volatility and lots of action. The price of the clearinghouse can rise dramatically. The collateral they demand can increase dramatically. Just as an example, in one day last week, total collateral in all clearinghouses rose from $26 billion to $34 billion in one day. $8 billion of extra collateral was demanded just because of the increase in risk from the rise of GameStop. And there's a potential for a kind of death spiral here. They go to Robinhood, who has this huge pressure on them and demand huge amounts of collateral. Of course, that's why Robinhood had to raise so much money, and that could cause fragile brokers to fail. Fortunately, Robinhood was able to raise the money. I think Josh is going to talk about clearinghouses. They are now a ubiquitous phenomenon. After the financial crisis, the widely accepted solution to credit derivatives was increasing the use of clearinghouses. This episode suggests they may be a hidden fragility in the system. The last thing I'll say is about Robinhood. Robinhood is kind of the anti-Robinhood. In the mythical Sherwood Forest, Robinhood stole from the rich and gave to the poor. And it's for that reason that people are sort of like, oh, Robinhood's a good guy. This Robinhood steals from the poor and gives to the rich. Robinhood as a app has used gamification and free trading to try to attract average Joes, retail investors, to trade in bubbles like GameStop. There were stories of people who took out mortgages on their parents' house to ride the GameStop wave, which is soon going to be crashing to zero. If there is one lesson from corporate finance that is totally accepted, probably the most accepted social science research of the last 100 years, it is that individual investors should not be trading in individual stocks. Robinhood, we're lost in all this, should not be encouraging average Joes to trade stock. Everybody should buy and hold the market mutual fund, low-cost mutual funds, set it and forget it, like Ron Popeil's rotisserie chicken thing. This phenomenon, if we learn nothing else from this, people should not be trading in individual stocks. And Robinhood, for that reason, I think is somebody that we should look with scorn on. Not because they stopped trading, that was because they were facing pressure from their clearinghouse, but their existence at all is what really is the troubling thing in this case. Okay, I'll stop there.
All right, I'll jump in now. So I agree with a lot of what Todd said. What I want to kind of talk about is the less thoughtful reactions we've seen in the kind of last week, calling for do something. The market's broken. We have to do something. And those take all kinds of flavors. Some are the ones Todd rejected at the beginning. Some are agreeing with his last point, saying we need to do something about Robinhood, not just look on them with scorn, but stop them from existing. And I have kind of doubts about all of these and want to talk about how they'll play out. So there's really three big buckets we can put them in. And I'll start with the weakest and worst ideas and build up. So the very worst Todd talked about, and Josh will talk about a little more, is punish Robinhood for pausing trading, right? And in this vein, dozens of lawsuits have been filed already. And if you look at the complaints, they're weak. They're weak because, one, they're just these unfounded allegations with, quote, overarching conspiracies where all the funds and Robinhood got together to stop trading in order to take money from retail investors. That did not happen. And almost certainly, as Todd said and Josh will explain, it's because Robinhood stopped trading because they had these capital requirements because of the clearinghouses. And that's mostly a good thing. It's a fragility perhaps, but we wouldn't want them to have not stopped and had the clearinghouse system collapse. That would have been much worse. All right, the second bucket would be what Todd will dislike the most would be do something about short sellers, right? This, oh my God, this is just another example that short sellers are bad. You'll hear this from, I think, the loudest kind of chorus that, this shows it. The politicians are already saying like short sellers are bad. As Todd said, it's not clear they are. And particularly in this instance, it's not clear they did anything wrong other than perhaps lose this battle with either the Redditors or other funds, which would be the kind of other theory out there. So we shouldn't want to do something in this instance about them. All right, so that brings us to the third bucket, which I think Todd's last comment will feed some of the people who want to do something here, right? And that is, we need to do something about retail investing. And here you have to ask, like, was this a retail investing question, or was it hedge fund against hedge fund? My guess is you had the Reddit retail investors and funds looking and playing a coordination game, saw this and then piggybacked on and tried to ride the wave up. All right, so do we regulate what the retail investors were doing? There's two arguments in favor of that. Right? We want to protect them from themselves. That would be the scorn Todd wants to put on Robinhood. Stop letting them fool these investors. Or we want to protect markets from the trouble they cause. So the first version is very paternalistic. We need to protect these people from the bad investments they're going to make. How do we know they're bad? Historical data tells us they're bad. Look at GameStop. It could not have been worth $24 billion on Monday, and probably now 8 today. It's not a world in which that is true. We don't live in that world. Regulating based on that seems to me problematic right now for two reasons. One, they don't want to be regulated. They don't want the protection, which always makes paternalism difficult. And at this particular moment, it would be a political disaster. What do I mean by that? People have been calling for the regulation of retail trade for a long time. Normally you do it when traders obviously lost. And you saw lots of stories this summer. People lost their savings on JCPenney. There were tragic results of other people losing money on Robinhood. And people said we should do something. No one did anything. So if the government jumps in right now and says, this is the moment that we're going to protect these traders when they think they've won a battle, you want to see people riled up. You want to see kind of angry people that you're trying to protect. That's what you will get here. And you'll say to them, oh, but we know better. And in some sense, that's true. Like there are people, like Todd described, taking a mortgage out to ride GameStop. That's a foolish idea. But some of the investors were bragging about their rationality, right? They were like, look, I know it's crazy, but I'm doing this. And it had this weird feel to it where they weren't buying the same thing that the market is normally trading, right? They had placed this intrinsic value in owning GameStop, unrelated to its fundamentals. And so there it reminds me of a favorite of law school professors who teach business law, is Green Bay Packers stock. So Green Bay Packers stock costs hundreds of dollars, pays no dividends, benefits not at all from earnings, isn't tradable, and has zero protection. It's totally worthless. 360,000 people own Green Bay Packers stock today. How do you value such a thing? It's almost impossible. Now, if you could trade it, how could I short Green Bay Packers stock? It would be impossible because I don't know what a Green Bay Packers fan would do to keep their stock. And in some sense, that's what this feels like. And to the political point of why it's so dangerous right now to regulate it, like, do you want to be the one who tells a Green Bay Packers fan they can't own that stock? I think regulating the GameStop traders is a lot like that if you do it right now. To say, oh, we're going to protect you because you shouldn't own that is like taking stock from a Green Bay Packers fan. So the second explanation is, what we really want to do is protect the markets. This isn't about retail traders. It's about the mess they're making for the market. All right. Again, the problem is I don't think the person you're trying to protect, the market players, would want that. Retail investors lose money on average. That's probably a bad thing, but it's a good thing for the market players. Short sellers normally make money on this, and they make money because they're adding value, but they also make money because retail investors are gambling and giving it away. They're subsidizing the system. So it'd be odd if the market was like, yes, we want to just get rid of retail investors. And you can't have it both ways, right? You can't have rules that say, we're going to let retail investors make bad decisions when they lose the bet, but we're going to regulate them when big funds lose the bet and lose out and the market gets messed up. Like, you can't let them only make the decisions that hurt them. That would be, again, a political disaster, and not like either you keep them out or you let them in. You can't kind of do this half version. All right. So in the end, you say, like, what are we going to do, right? As Todd said, I don't think it's as big a problem as people are kind of making it out to be. Hedge funds are not going to leave the market after this. It was only a few stocks that went up. You know, there's a handful of them that were in this kind of bundle. The markets didn't fall apart. It wasn't like the lack of price discovery for GameStop was leading people to think GameStop was, like, leading banks and lenders to think GameStop was actually worth $24 billion. As Todd said, capital wasn't misallocated. The same was true of BlackBerry and Blockbuster, which were also kind of brought up into this wave. There's one stock that's complicated, where capital may have been misallocated, or we may really like retail investors. That's AMC Theaters. So AMC Theaters got brought along on the wave over the last 2 weeks. AMC Theaters has been on the brink of bankruptcy since COVID began, since the pandemic. All right. Last month, they said, we need money to stay in operation. We need like $1 billion in order to keep going. So last week, one of their creditors converted $600 million of debt into equity and sold it for $16 a share. At that moment, $600 million of debt gone off AMC's books. They were also able to raise $300 million in new shares over the last few weeks. So they've got $900 million that they were looking for. This is very good for AMC's creditors. AMC, it might actually now have a lifeline to get it through the pandemic and see if theaters come back after we're on the other side of this. It might be a misallocation of capital, right? If you believe the shorts were right and the retailers were wrong, then AMC should have crumbled and shouldn't have ridden this wave. I'm skeptical that anyone knows the answer to that, right? The value of AMC is tied up in what happens with vaccines tomorrow, right? And that is something that we've seen, the uncertainty is very high. Like, it's hard to know exactly where things are going. And I don't think the market can predict it. I don't think retail investors can predict it. And so you have this big uncertainty, like, who was right? We don't know. What we do know is a bunch of retailers gambling who maybe then started a hedge fund versus hedge fund fight have now kept AMC alive. That's not the worst outcome, right? It might be misallocation of capital, it might not. And if we try to regulate this, you're going to have to know the answer to those questions to get it right? Was it good that they wiped out 10% of their debt or not? The really bad version would be it was bad, and now firms like AMC and Hertz and other firms are going to waste resources trying to light the fire under Reddit in order to save themselves. That's a waste. But how do you figure that out, right? How do you stop that? How do you protect retailers from their own optimism or short sellers from these anomalous situations without messing up the markets further, like pulling a string that pulls other things you don't know it's connected to? And I think Josh will talk a little bit about how capital requirements sometimes have this effect of affecting something you didn't expect. And then regulation begets regulation, and you have a big mess. So I think any action right now is tricky. And I also think the hearings are going to be dangerous because emotions are high. Our political atmosphere is very on edge right now. And I just think if anyone goes into a hearing thinking they're going to regulate retail investors, they might come out with a short sell ban, or they might come out with new capital requirements. And any knee-jerk reaction has the risk of doing the exact opposite. And as one kind of piece of evidence on this, if you look who's calling for specific things, it's new players. So on the other hand, look at Senator Warren. She's been talking about regulating markets for years. This is something she's in. Her statements have been very ambiguous. It's like, well, we should regulate. The how and what, nothing. Because this is politically fraught and the answers are not clear. And in some sense, like the uncertainty of doing anything, I think the cost of that, like doing anything right now, the cost of that likely outweigh any of the benefits you gain from fixing this little problem, which I do think ultimately will be an entertaining but little problem. With that, I'll hand it over to Josh.
Can I have a point of personal privilege first? I need to say that I'm not in favor of regulating anything. I think Robinhood is shameful. Maybe a public education campaign I would be in favor of, but I'm against regulating retail investors. And then just one other thing, which is, as to Green Bay Packers fans, as a Bears fan, I'm in favor of taking everything from them.
Well, I 100% agree on the second point. And on the first, I didn't mean to suggest that, just that your scorn might lead to that.
We actually have a colleague who I didn't peg as a sports fan, but I learned about a week ago, he's a Manchester United fan because he owns stock in Manchester United. And I certainly don't want to be the one to tell him he has to stop supporting Manchester United. I want to follow up on a lot of things that people have said, that Todd and Tony have said. But I want to go into sort of more excruciating detail about some of the market structure issues they've started to talk about, and in particular, pick up on a point that they both made, but that the relationship between retail investors, market structure, and systemic risk can lead to more unanticipated consequences when trying to reform these types of things, and also efforts to regulate or limit the type of activity that contributed here may have real problems for market liquidity. And on top of that, I want to highlight the tension between regulations designed to limit systemic risk and attempts to protect retail investors. So people got really, really mad when DTC and NSCC limited and even froze for a little bit of time GameStop purchases. There were conspiracy theories that large hedge funds or market makers or short sellers were bribing them. But it turns out that a much less nefarious and more mundane explanation, that one that Todd went into some detail about, appears to have been what was going on. So to give a little bit of background for those who don't know, a clearinghouse is an intermediary that steps into the shoes of buyers and sellers when securities are traded. So in that way, they guarantee performance by their own customers and performance by counterparties. They mutualize risk. If so you sell me a stock, I don't end up buying it from you, you sell it to NSCC, who sells it to me. There are other steps involved, but as a basic, the basic fact to remember is that there's this intermediary, and it is designed to eliminate counterparty credit risk in most securities transactions. So the way, there's this dangerous point in clearing, which is the time between when I buy a stock and when it's settled 2 days later. In the United States, it takes 2 days to settle trades. This is called T+2 settlement, that NSCC accepts orders, but you won't have the actual security end up in your account for 2 more days. And there are conflicting explanations about why this might be the case, and there's a large movement that I'm supportive of for real-time gross settlement. One explanation is that powerful players stand to benefit because they're able to lend money that they have during this period. Another explanation is, again, more mundane, which is that infrastructure is really, really expensive, and moving to instantaneous settlement would be costly. But in this 2-day settlement period, parties face significant risk, and in particular, in periods of significant volatility and when trade volumes are high, members of clearinghouses have to post more collateral. And this, again, is exactly how the market should work. The reason is that when volatility is high, the risk that one party won't be able to honor its obligations, say because it goes bankrupt, increases. And so that increases the chance that the clearinghouse will have to perform that party's obligations. So what the clearinghouse does is its member firms post collateral. Collateral requirements increase when volatility is high and when trade volumes are high. Again, this is totally mundane and ordinary. You want more of a cushion when there's more risk. But what this reveals is, or one thing that people were complaining about a lot, especially retail investors, was that they couldn't trade through Robinhood, but big guys were still able to buy and sell. And this is, again, not surprising in any way. Large hedge funds may themselves be members of NSCC, in which case they can just post their own collateral. They may have access to multiple brokers, in which case they may be able to use someone who's not Robinhood, that's not available to ordinary retail investors. But I think this highlights one really interesting tension between regulation designed to protect against systemic risk and the ability of retail investors to compete on fair terms, which in some ways supports Todd's point that retail investors can't beat the market. And that is, if you're trading during a period of extreme volatility, or in a sort of, I think, more problematic future scenario, if you're trading right around when a recession hits, this entity you have no role in, a clearinghouse, is able to stop you from exiting your position. And larger parties are less likely to find themselves in that position. And again, this is sort of a totally, maybe an accident of the way we've structured this market, but it means that retail investors are participating at a disadvantage because the they face a risk that at the worst moment to be frozen into a financial product, that's exactly the outcome they will face. And so that's one. I think that many of the problems GameStop has illustrated are overblown. I agree with Todd and Tony in that respect, but it illustrates this tension, and it's one that's sort of a natural corollary to something a lot of scholars have thought about, which is that a lot of financial stability requirements, such as capital requirements, benefit big players. If you're a bank with $1 trillion and you have to post $1 billion in capital, it's a lot easier for you to pay for that than if you're a bank with $1 billion. But I had not really thought of it in the context of retail or consumer protection. And it appears that that same phenomenon is operating in this context as well. And so in terms of reforms that we should think of, the first one I want to suggest is, I, like Tony and like Todd, I think, who's especially vocal in this respect, am leery of telling retail investors, you can't participate in the market. I'm especially worried about it when people think of securities as a form of artistic or political expression, or when you're responding as you might now, and the one time they actually made money. But the one reform that does seem really compelling right now is real-time settlement. That the risk that builds up in this 2-day period, we see that there's financial risk, that in a recession, the fact that a clearinghouse can increase margin and so take money out of the market to increase make sure it's more resilient, that is countercyclical, and also that it harms consumers at the worst possible moment. Now, that won't solve all of these issues, but I do think this is a compelling argument for real-time settlement. The second thing I want to talk about, moving past clearing, is the relationship between high-frequency trading or market makers or payment for order flow and retail investors. So another group that got a lot of, I think in this instance, misguided criticism were high-frequency traders. People, these firms that stand willing to buy and sell at every moment. Market makers, they're willing to sell securities to buyers and buy from sellers, and they make money on the spread. So critics of high-frequency traders like to liken them to sort of blood-sucking vampires, but really they provide an important liquidity service. And there were rumors that high-frequency traders or market makers were the reason that Robinhood had to freeze trading. I haven't seen any evidence of that. I agree with Todd that the decision to increase capital requirements in the general market from 26 to 34 billion seems like that was clearly why Robinhood froze trading. But they were on the short end of a great deal of criticism. And I actually think the other surprising takeaway I had from this GameStop experience is that retail investors, even if they're always losing money, provide a very valuable service to the rest of the market by facilitating market making and liquidity. And they don't just do this because they're stupid. They don't do this because high frequency traders like Citadel or Virtu are able to arbitrage better with them. They do it because retail investors almost never move the market. Market makers, when they're facilitating trades involving other participants, are very, very worried that, say, California pension CalPERS is going to move the market through a transaction. And so those types of trades are much, much riskier for high frequency traders. And so retail investors, it's a little bit strange to think about this now where they actually move the market, but it's much rarer that they'll have that effect. And so market makers are much more excited to work with firms like Robinhood. And so there's actually a positive externality from the existence of retail investors, which is that they provide pretty significant liquidity benefits to everyone else in the market. So, what this means, whether, I don't think that's the be all end all in terms of we should freeze retail investors out, but I think it's a reason to think like there really are some unintended consequences to reforms that would limit these types of transactions. And that's something we should be cautious about. And then the last thing I want to say is there's one other area where I think if we're worried about retail investors, this is another GameStop's not unique. I think experiences with Hertz and AMC and JCPenney are other examples of this. But I do think it's worth looking at whether Robinhood and other brokers like Robinhood are taking steps to push products that are more profitable for them. So it's sort of misleading to say that Robinhood offers a free service. It's sort of free when you're buying from Robinhood, but it's being paid by market makers, and they're making money off the bid-ask spread. And this is something that I think it would be worth learning more about. But for example, Robinhood makes much more money off of selling options than other types of securities, and it appears that, and that's because market makers are willing to pay a lot more for options because they make more money from options. And so I don't think we want Robinhood to push securities onto consumers simply because Robinhood makes more money. And I don't think there's enough information available right now to say with certainty if this is the case, but I think it would be worth looking at, like, how does Robinhood push products on people? What are its little notifications? And whether some types of products are that are risky are being advertised in a way that benefits, that reflects the fact that Robinhood is paid more by firms like Citadel than any other factor.
Great, thank you, everyone. Professor Macey, we have a question for you. Does the GameStop episode pose any systemic risk? If not, then does that mean the people who lose are just out of luck? This will make them madder than ever because only TBTF organizations get rescued.
Yeah, I mean, I think, look, it's really hard to say. The type of systemic risk we're worried about with clearinghouses is that a clearing member fails. And so here, there were hedge funds, particularly people who had a net short position, who were squeezed really hard. And I think it's, DTCC's rules and NSCC's rules are pretty clear. I don't see, this is exactly the type of situation that could lead to systemic consequences. And you might think the reason Citadel bailed out a smaller hedge fund was out of concern that there were such systemic consequences, but I'm not comfortable saying, like, yes, this is a systemic consequence. This was systemically risky, but it's exactly the type of thing we should be worried about. And I think we should be reassured that that NSCC and DTCC acted the way they did. And finally, I think it also should make us aware of the extent to which clearinghouses can suck up liquidity right when you want liquidity in the market. And so I think it really does reveal that clearinghouses are in a position to prevent JP Morgan and Merrill Lynch from, they can basically demand immediate collateral in a way that can accelerate a crisis or take money out of the market. And that is something we should be worried about. But I have no certainty that that Robinhood was going to trigger the next financial crisis.
Thank you. Professor Casey, a question for you. You talked about how regulation may not work, but we have a question asking, should short sellers be required to publicly disclose if they have shorted more than a certain amount, such as 5% of the shares outstanding?
My instinct would be no. I'm not sure how that would change the system. I take the question to be, we worry about the shares being naked. We worry about being way over, and we might be able to prevent that by having disclosure. The real risk is, and this is all investment strategy, and the way they're adding information is they're discovering prices through a strategy, and they're going to say it's proprietary. If I reveal this, you're all going to figure it out, and you're going to push us out of the market. I'm, not knowing exactly what everyone's short strategies are. I assume that's true, and I don't see that the benefit would likely come from it. That's my.
Can I jump in on this?
Can I just jump in and say that in in the Dodd-Frank Act, Section 929XA, little x, big X, little a, Congress required the SEC to write a rule requiring disclosure of shorts. So every quarter, hedge funds report 13Fs. Hedge funds of a certain size form 13F that discloses their long positions. And Congress wanted the SEC to require them to disclose their short positions. The SEC has never promulgated that rule. And I'm with Tony in thinking that's a good thing. There's all this bias against shorts already. What motivated that disclosure provision. And I think the susceptibility to targeting shorts with a squeeze would just increase massively if they had to disclose these positions. So I think the SEC saved us, an administrative agency, saved us from an irrational Congress in that instance. And I should just point out, one of the reasons why I'm pretty confident that this was hedge funds behind this is that somebody figured out that Melvin Capital was short GameStop. Now, how could they do that? Well, Melvin Capital discloses its long positions, and it disclosed apparently a bunch of long puts in GameStop, which were hedges on its short in GameStop. This was not like, Frankie Jones, ... poop emoji, a unicorn emoji on Reddit. This was some hedge fund who figured this out. And I think disclosing shorts would lead to really bad consequences.
Yeah, I just want to very quickly add a few things because I think this is a really important question. This seems to be one place a lot of people are pushing. I'm not categorically opposed to disclosure, but I think it's really important to be cautious and skeptical, especially of aggressive disclosure rules. So one, people hate short sellers, and with a real passion, to the point where short sellers experience physical risks. And we don't think about that a lot, but it's worth being aware that short sellers are often the subject of death threats. Thing two, it often takes a long time to build your short position, and it would be a deterrent to shorting, and I'm with Todd that shorting is beneficial if you couldn't build your short position because the stock price went down as soon as you disclosed that you thought the company was terrible. Thing three, short sellers automatically have an incentive to disclose, right? If you are short a company and the bubble goes on for 1,000 years, you're really out of luck. So you need the bubble to pop in your lifetime, and it gets more and more expensive as the bubble goes up. And so a lot of short sellers go around saying this is the worst company ever. We're not always at risk of too little disclosure. And then the last thing is that some of the people who hate short sellers are the companies. Some of the people are other hedge fund investors who, as Todd and Tony said, have tools available to them to squeeze short sellers. And disclosure can really exacerbate that. So you see these really high profile fights between Bill Ackman and Carl Icahn in Herbalife, where once disclosure happens, people who are opposed to those short sellers take really aggressive steps to squeeze them. And so I think maybe there should be a discussion about disclosure, but it's really worth bearing those things in mind.
Thank you. Professor Henderson, a question for you. You mentioned Melvin Capital. The question is, do you believe there is a substantial conflict of interest between Robinhood, Citadel, and Melvin Capital? If so, at what point did this conflict of interest occur? And at what point should Robinhood or Citadel have acted to resolve or prevent the conflict?
I don't know. I don't think we have all the facts. And as Kierkegaard said, a mob is untruth. What we saw in the wake of this was mobs. I saw people on YouTube posting videos with the wildest kinds of conspiracy theories, Trump-style conspiracy theories about how Ken Griffin had paid Janet Yellen and called up the trust. I mean, it was just crazy. And then you saw the political stars align in ways that I thought were the sign of the apocalypse, that Representative Ocasio-Cortez and Senator Cruz were agreeing with each other for a brief shining second of stupidity. So we don't have all the facts. I'm pretty confident for the reasons that Josh and Tony have given that this was not a giant conspiracy theory, that Robinhood, and I signed up for Robinhood account without putting any money in, just so I could snoop around and engage the enemy. And I got emails from them, 4 or 5 emails from their CEO in the last few days talking about the exact reasons why they did what they did. This is the most highly regulated industry, maybe nuclear, and then this on planet Earth. And the idea that there would be some giant conspiracy behind this, as opposed to a bunch of people just following a bunch of rules that may be smart rules or not. I'm with Josh in thinking, somebody should deploy the blockchain, which I know nothing about, but some distributed ledger technology to make settlements happen immediately and blow up this bureaucracy, which seems like it's fragile and is being used by people in clever ways. But I think we should all be intelligent enough to reject these kind of crazy, second shooter on the grassy knoll kind of conspiracy theories.
Thank you. Professor Casey, 2 questions for you. The first is, will Redditors be convicted for market manipulation? And about short selling in general, do brokers of normal retail investors loan out the investors' shares without disclosing this, i.e., is this buried somewhere in the terms and conditions?
All right. So the first one, I don't think so. And I don't think they should. I've seen theories out there. People, people think about this a lot. A lot of professors say, this falls under the definition of market manipulation. If this does, that is a can of worms that we do not want to open, because so much stuff that so many people are doing would fall under it if simply telling people, hey, I'm going to buy this, you should buy it too. I don't even imagine how we could bound that. Now, some people said, but what we should do is investigate to see if there's conspiracies. I'm with Todd. I don't think there are. I'm also, back to the main point I made, if you start sending the government to get emails from Redditors because you think there might be a conspiracy, you're gonna rile up something you don't want to rile up. I just don't think this is that kind of problem. All right, so the second question is, are they loaning securities out by hidden terms? I mean, it's not a hidden term, it's right on the page. They say one of the ways we make money is loaning margin securities. It's very clearly that's one of the things they do. So yes, Robinhood is doing that. I don't know how much they're doing it, but it's not a secret. It really is on their website as the third way they make money. Right? They make money by the flow that they send. This is where people think there's a conflict, right? To someone like Citadel. They make money. They offer the gold service, and then the third thing they do is they loan securities. There's three other things they list as well. But so they loan margin securities out, and they make money off that. So yeah.
Can I just add one thing to that, which is I agree with everything Tony said. No way the government's going to go after a bunch of retail investors. Politically, that would just be crazy. It looks a little bit like, downloading files, and they did go after some individuals, downloading music or whatever, Napster and so forth. I can't imagine the SEC going after a hedge fund if they could figure out exactly the hedge fund or 3 hedge funds that were trying to work in concert to screw Melvin Capital. If that were true, it's possible. I will say, however, and it would be politically fine for the SEC, and that's probably something that we don't need, is hedge funds sending the price of GameStop up to $468 to screw another hedge fund because of some beef you had on the basketball court or at a bar or something or whatever it was. I will say, though, the SEC has been very reluctant to bring market manipulation cases. What is artificially creating movement in the supply or demand does not reflect intrinsic value? As Tony suggested, that's a gigantic can of worms. Maybe they could do it in this limited case, but the target would be a hedge fund, not a Redditor.
Thank you. Professor Macey, a question for you. What are some of the disadvantages or risks of real-time settlement? You mentioned infrastructure costs. Are there others that come to mind?
There are two costs that people talk about. One is infrastructure costs. The other is liquidity issues, that the firms that are basically members of clearinghouses are able to use the collateral that they collect for productive activities. Overnight lending comes to mind. It's really hard to get a sense empirically how convincing that is. I'm really skeptical that there are real problems associated with it. And it's worth noting that the US is a real laggard in payment speed. And it's pretty shocking how non-American jurisdictions often have much faster settlement times in the United States. And I think it's really, there's no justification at this point not to shift to faster settlement. And in fact, DTCC in 2018 said we could do this in real time, and the Fed has begun to build out a platform for payments involving the Federal Reserve System that would settle in real time.
Thank you. A question for all three, whoever wants to answer. Are there any risks to shorting more than 100% of the shares of a stock that exist?
I can dodge the question, but say something that is directionally relevant. I think when Tony and Todd were talking about shorting, one thing lurking in the background that is really important is what role market power plays. There have been situations where someone on the opposite end, someone who's long in a company, buys all the bonds and makes it impossible for short sellers to get out of their position. And so I think there are, insofar as the question gets at market power issues like that, there may be concerns. I think I think you want to go after such behavior directly by just bringing market power and anti-competitive. This is a violation of competition laws, and so I think that's my like how I would think about that type of problem. But on its face, I don't think it's all that problematic. In fact, it should mean that there's a real market for these things. Though when companies become really, really, really worthless, it can be hard to cash out of if no one's willing to sell, if there's or buy, it can actually be hard to make money off of a short for because there's no one in the market.
I would have given the same dodge, Josh. And in fact, the case he's citing, and I forget the guy's name.
Falcone,
yeah. He was so blatant about it. And when they called up, people who were short called up to have access to the bonds, and he basically said, like, I'm deliberately doing this to screw you. And the SEC didn't even bring a market manipulation case in that instance. An incredibly famous anecdote on Wall Street. And so the fact that you could end up with more shares being lent out is just an artifact of the kind of point Josh was making, and leads to the squeeze problem, which is always out there and existing. I'd be leery of any kind of regulation that was, I think we might be trying to kill a flea with a sledgehammer. But, we'll see whether this episode gets repeated. I'm hopeful and optimistic, which is surprising for me after a year in quarantine, that this is going to be a humorous one-off, as Tony suggested, but we'll have to wait and see.
Yeah, I'll just add on that. I mean, the point that it leads to the squeeze is somewhat the thing that regulates the problem, is that you're putting them in that position, you're putting yourself in that position by shorting in a market like that. And you got to make people, you want to make that the person, kind of pay the price of it. And another big example was the Volkswagen squeeze that looked like that, where within a day, Volkswagen tripled in value and became the most valuable company in the world, precisely because, and this is the point about people announcing it, like Porsche had started buying to stick it to, Porsche was a major owner of Volkswagen, to stick it to the short sellers. And ultimately there were too many shorts out there and not enough shares, and the value kept going up and up. And then there was litigation afterward about whether they had to pay and whether they'd give money back. And like, you kind of want to make the person who fell into that, I think, suffer the consequences, and then it becomes somewhat self-regulating.
You can also make synthetic shorts. And so if you buy a put and a call at the same price, you don't need to, the concerns about like, do we have enough shares shouldn't be a real problem in markets where people are able to take advantage of other products that reach the same outcome.
Professor Casey, a question for you regarding the driving force of what may seem as a conspiracy theory is that Robinhood stopped buying but didn't interrupt selling. Can you clarify why that was?
If I understand correctly, and I'm not 100% sure that's 100% right, but it would make sense in the following sense. And Josh can maybe follow up on this, but it goes to that point about the clearinghouses. If all your trades are going in one direction, or most of your trades are going in one direction, and they're highly volatile, that's going to increase the amount you're going to have to put up as collateral, right? Because they're worried that you can't offset those. And so if your volume is mostly buy, the sells aren't the problem. It's the buys that are the problem that are causing the risk for the clearinghouse. So they might say that you're going to have to postpone for every new buy, not for every new sell, because the sells are covered. I think that would be what's driving that.
Yeah, question. That's what's going on. And just to put it another way, I guess, Robinhood is a clearing member. Robinhood it nets out trades. So what that means is if it has one order to buy GameStop and one order to sell GameStop, that doesn't affect its collateral at all because those trades cancel out. So the reason Robinhood had to post more collateral was it had more buy orders than sell orders. Every sell order that Robinhood got lowered the amount of collateral it had to post. And so at the time, Robinhood really, really wanted sell orders, and that reduced the amount of the risk that NSCC or DTC that NSCC would face of sort of that Robinhood wouldn't be able to honor all of those obligations because Robinhood the amount of buy orders coming from Robinhood declined whenever Robinhood got a sell order.
A final point, and I endorse both of those. A final point is that what is the theory? What is the motivation they would have for screwing their customers? That's not something businesses usually do. The ones that stay around for a while. And the story is something like, again, Ken Griffin, who I think you can see his apartment in Josh's background there. He's at the top of one of those buildings. He's paying Robinhood. Well, of course, Citadel pays Robinhood. It's called payment for order flow. They want to attract Robinhood's trades to Citadel, and they make fractions of pennies on all those trades. That's a perfectly natural phenomenon that happens in our now diffuse way that market makers function to create liquidity in the market. That's a good thing. Having competition in brokerages and exchanges, which is facilitated by payment for order flow, also a good thing. And brokers are bound by various duties of best execution that limit them from routing those trades to places where customers will be disadvantaged. But payment for order flow depends on having orders. And if Robinhood deliberately screws its customers, there will be no orders for it to flow anywhere. So if Robinhood got caught, doing the bidding of Ken Griffin, they would be out of business tomorrow. Everybody would just delete the apps from their phone. So that's just like not a viable long-term business strategy. So that cannot be what happened.
We'll do one final question for the group. Does this episode give you any concern that larger, more organized firms will increasingly start to try and use social media platforms or misinformation to weaponize third-party retail traders against each other?
I'd say yes. I mean, that was kind of the end of my talk that I said. The one bad thing is if this creates an incentive for firms to try to light this fire. And you could imagine that on various ways, like a company is in distress and they want to get, a kind of information campaign to push their stock up. They might spend money to do that. They might hire someone to try to do that. Or I think as the question is suggesting, a hedge fund does it because they want to, as Todd said, battle and play the game with the other hedge funds. Here it might have been, a hedge fund starting it. That's kind of what Todd was suggesting, or it might have been a hedge fund joining in once they saw it. Those are problems, and this gives some incentive to it. Whether, I don't think the more we see of it, the less the less successful it will be. Like there'll be ways to counter it, and that, right? The market is the market, and there's smart people on both sides playing the game. So I'm not overly concerned, but I do think it will happen. There will be wasted resources.
Yeah, I mean, I agree with that. I was talking to a major Wall Street outfit yesterday, and they were kind of aware they had some people who read Wall Street Bets, and you'd hear it come up. Some of their IPs would talk about it. Now they're all in. They've hired people to write scripts to scrape and do and this and that, so the war is on, as Tony suggested. Whether there'll be another kind of Arab Spring moment of the Redditors and hedge funds, we'll have to wait and see. But the battle has been joined. And I think, there's strategies people could use on the other side. I mean, it's not surprising that this was GameStop that was the target here. This wasn't like some aluminum manufacturer in Cleveland. And I just think, like, yes, there could be things like this where people have the kind of Green Bay Packers irrationality that Tony talked about that get people motivated. But at the end of the day, like I said at the beginning, it wasn't like GameStop did a secondary stock issuances at $468. It wasn't like there was a massive capital allocation. A bunch of people lost a bunch of money, and a bunch of people made exactly that amount of money. We should all just walk away from this and say, it's tragic there were retail investors who were losers. This is just like Vegas. And, you feel sad for the losers and happy for the winners. But it is a lesson about, the risk for retail investors in trying to beat the pros. You can't do it. You shouldn't try.
I don't have anything to add, except I don't think this is new. People always go around saying, this is the greatest stock ever. This is the worst stock ever. But we're now just seeing that like timeless phenomenon meet the internet and social media.
Well, that's all the time we have. Thank you, everyone, for joining. Thank you to our panelists. I do apologize. There were many, many questions we could not get to. But again, check the law school website for articles for these panelists, for their written articles. And thank you, everyone, for joining. Have a great evening.